Okay, dear student, let's start the discussion. Your FR pre-scene mock, and in the coming there will be on section C. Inshallah, we'll be conducting the class on coming Tuesday. Today, let's try to discuss questions from section A and B. Which two of the following criteria must be met for an asset to be recognized in the financial statements according to the conceptual framework for financial reporting? According to the conceptual framework, criteria must be met for an asset to be recognized in the financial statement. Now let's read. Recognition of asset provides verifiable information. There is no such thing given by conceptual framework. Recognition of asset provides relevant information. True. So according to conceptual framework, you should be recognizing the asset because recognition of asset provides relevant information. Cost of asset is capable of reliably measured. There's no such thing said by in the conceptual framework. Recognition of asset provides users with the faithful representation of the asset. Okay. At what amount should the building be measured in Greek statement of financial position at? So they're basically asking on December 31st, number X5, at what amount should the building be measured in Greek company's statement of financial position? Date is December X8, 31st December X8. Let's read. Greek company, a company with a 31st December financial year, decided to sell one of its building on 1st October X8 and immediately started to market it for sale at its fair value. A potential buyer has been found to purchase the building in its current condition. The building is ready for immediate transfer to the buyer as soon as the price negotiations are complete, and sale is expected to take place early in X9. Student, this is I would say scenario of IFRS 5, non-current asset held for sale and discontinued operations. If you just recall IFRS 5, obviously it is written in IFRS 5 that your non-current asset should be saleable in its present condition. And once the criteria is met within 12 months, assets should be sold, and all things are happening here. Of course, we can see that within 12 months, it is highly probable this asset will be sold. So obviously we'll apply IFRS 5. Under IFRS 5, the day you are applying IFRS 5, on that day, you have to recognize the asset lower of carrying amount and fair value minus cost to sell. But they're not asking us what is the value of this asset on 1st October X8. They're asking us the value of the building on December X8. The following information is relevant to the building on this 31st December X8. Carrying amount on 1st October X8, they are giving us 5 lakh. Fair value 1st October X8, they are giving us 525. Cost to sell is 70 now. This is not the answer. 1st October X8. Under IFRS 5, your asset will be lower of carrying amount, which is 5 lakh. The second is fair value minus cost to sell. Fair value minus cost to sell. Fair value is 5,25,000 minus 70. 5,25,000 minus 70. I'm getting 455, but they're not asking us what is the value of this building on 1st October X8 by using IFRS 5. They're asking us value on December X8. Now let's see on December X8. Fair value in December X8 is 505. We can see there's a further decline. Minus cost to sell 70. 505 minus 70,000. I'm getting 435. So December X8, the value of this building At what amount should the building measure in Greek statement of SOFP? That is 4,35,000 on December X8. Indicate for each of the item listed below whether the expenditure should be included in the cost of inventory or recognized in the profit and loss in accordance with IAS 2 inventories. Number one is an allocation of fixed production overheads. Yes, it will be included in the cost of inventory, fixed production overheads. Abnormal amount of waste material, P&L. This cannot be a part of your inventory. Cost of storage after completion of inventory. So cost of storage after completion of inventory is your storage cost. It is not the part of cost of inventory, P&L. Okay. Select the appropriate IFRS accounting standard that should be used to account for each of the components of tea company's tea plantation by matching the correct token to correct components. Tea company grows tea bushes on its tea plantation. When the leaves from the bushes have reached maturity, they are picked and then dried using a drying equipment. Of course, tea bushes, bearer asset, that's bearer plant. Under bearer plant comes under IAS 16, property plant and equipment. Actually, the characteristics of the bearer plants, they're just like normal plant and machinery. What happens in normal plant and machinery? It has a useful life. Here, bearer plant, they have a useful life, like tea bushes, they have a useful life. Second, during their useful life, plant and machinery will be using them to, let's say, manufacture, produce XYZ product. Tea bushes during their useful life will give us tea leaves. Then under IAS 16, plant and machinery, normally at the end of their life, there will be hardly just a scrap value will be there, nothing else. Same thing is here. So at the end of their useful life, tea bushes, obviously hardly there will be any incidental value. There's a possibility there will be no value. So since bearer plants, they meet the characteristics of property plant and equipment, so that is why on bearer plants, we apply IAS 16. So tea bushes, bearer plant, IAS 16. So, okay. Now we have to match tea bushes, tea leaves at the time of picking means harvesting, IAS 41. Drying equipment is IAS 16. Basically, drying equipment is IAS 16. Tea bushes, IAS 16, property plant and equipment. Tea leaves at the time of picking. So basically, they are agriculture produce. And at the time of harvesting on agriculture produce, we apply IAS 41. So tea bushes, why we are applying IAS 16? Because tea bushes are bearer plants. On bearer plants, we apply IAS 16. So, okay. Tech company received 3 million loan from its local government to assist with expanding its business operations. To build a private college, the loan has an interest rate 1% and repayable over 3 years. The prevailing market interest rate for similar loan is 6%. So instead of 6, you are paying just 1. So government is nice towards you. Select the correct answer to describe nature of the loan received. The loan received is your financial liability, of course. You have to repay the loan. And the value of the benefit received in accordance with IAS 20 government grant. The loan received from the local government is considered to be a financial liability. Now, the value of the government grant received. Now, listen. Number one, whatever amount, which is 3 million we have received, that 3 million is not your government grant. That 3 million is your simply financial liability. Now, instead of paying 6%, we are just paying 5%. So the benefit to us is 5%. Repeat. Normal market interest rate is 6%. We are paying 1. So how much interest actually this company is going to save? 5%. So that 5% is technically is your government grant, and that will be recognized over the 3-year period as income, because we'll be saving 5%. So right now we don't have options in front of us, but if you go to the, I would say, the main CB platform, you will see the options. So logically, the saving in the interest is going to be our income, but over 3 years. Okay. Which of the following statement is correct according to IAS 37, provision, contingent liabilities, and contingent assets? Golden Company has purchased land for its mining operations. The purchase date was 1st August 2008. Government legislation requires that Golden Company restore the land after a 5-year period. At 1st August, Act said the cost of restore the land based on an environmental expert advice is 180. 180. Now, student, listen carefully. 1st August 2000 Act said they are giving you the value of restore land. The value is how much? 180. Logically, this 180 itself, it is in present value terms. Otherwise, we know that when I have to restore the land at the end of 5 years, I have to calculate the present value. And the double entry of that present value is I'm going to debit the land, I'll credit the provision. But this 180 itself, it is a present, is in its present value terms. There's no further discounting. So after, from here onwards, there will be unwinding of discount, and due to unwinding of discount, finance cost will be debited and provision will be credited. Now read it again so that you should know why it is 180 is in present value terms. At 1st August, Act said the cost to restore the land based on environmental expert advice is 180. An appropriate discount rate is 6%. So by using this 6%, we will be doing unwinding of discount, no discounting. Golden Company has year end 31st December. Okay, now just a minute. Logically, on 1st August, we will debit the land by 180. We are going to credit provision by 180. Then 31st December. If you count the time period from 1st August till December, we have got 5 months. So there will be unwinding of discount for 5 months, 180 into 6%, 5 by 12. 1,80,000, 6%, 5 by 12. Students, I'm getting 4,500. So basically, finance cost. We're going to debit finance cost by 4,500 and provision. It means in SOFP, your amount of provision will be 1,84,500. This finance cost 4,500 goes to P&L. Okay, now let's come here. On 1st August, Act said Golden Limited should recognize a provision equal to the present value of restoration cost corresponding. You will not expense out. Can I say land will be debited? On 1st August, X8, Golden should recognize provision equal to the present value of restoration cost corresponding debit entry to land. Okay. The carrying amount of environmental provision, no, it's not coming this. On 1st August, Act said Golden Company should recognize a provision equal to the present value of restoration cost corresponding debit entry to land and carrying amount of environment. Yes. Logically, C is the correct answer. Let's see the last one. On 1st August, Act said Golden should recognize provision equal to the present value of restoration cost. No, again. Debit has to be land, not PL. So C is the logical choice. Which statement is correct in accordance with IAS 32, financial instrument presentation? Indeed company issued 20 million convertible loan notes. Convertible. Students, if you recall, convertible loan note is your compound financial instrument. It is your compound financial instrument. According to IAS 32, it is the responsibility of a company which issues compound financial instrument to split that into debt and equity component. And we know that from the compound, I'll deduct the debt component, balancing figure is going to be equity component, then slowly and gradually, due to unwinding of discount, debt component will keep increasing. Okay. Issue 20 million convertible loan notes on 1st July X3 in 5 years' time. On 30th June X8, the holder can choose to redeem the loan note for cash or 20 million or to convert them into fixed ordinary number of shares. Okay. At 1st July, the present value of the loan notes, similar terms but without conversion, is 18.97. 1st July. Logically, at 1st July, this is the date, debit and credit. We've got 20 million cash. Debt component, we know that. The debt component, financial liability, 18.97. Equity component. Equity component, your equity instrument is the balancing figure. 20 minus 18.97, I'm getting 1.03. Now, basically throughout the next 5 years, your equity component will remain same. Repeat, throughout the next 5 years, logically your equity component will remain same, but due to unwinding of discount, this 18.97 slowly and gradually we will keep increasing this. At maturity, your debt component will become equal to 20 million. Repeat, your equity component will remain same throughout the next 5 years, but debt component, due to unwinding of discounts, slowly and gradually it will keep increasing. Let's see which statement is correct in accordance with IAS 32. At 1st July X3, indebted company should recognize liability 18.97. Okay. If the loan notes are converted on 30th June X8, 18.97 is transferred to equity. Can I say slowly and gradually this 18.97 will, due to unwinding of discount, will keep increasing, and at maturity it will be equal to 20 million. It will not remain 18.97. That is the equity component which does not change. At 1st July X3, indebted company should recognize equity component 1.03 million. Fine. This balance is subsequently increased to 20 million by 30th June X8. Now, please read what it says. They are saying your equity 1.03, we agreed with that. Then they are saying this balance will subsequently increase to 20. Now, listen. If why this one is incorrect? At maturity, if lender, at maturity, if that bond is redeemed, at maturity, if the lender is asking for the cash, so obviously there will be no equity component. Repeat, I'm the lender, I'm the holder of a convertible bond. I have two options. One, at maturity, I can get the redemption amount. Second, I can convert my convertible bond to ordinary shares. Why the third one is, the second part is incorrect, because what if the investor is asking for the redemption? You will have to pay the cash. Then there will be no equity component at all. But first part is correct. At 1st July X3, indebted company should recognize 18.97 liability. Logical. An interest expense 1.03 million is recognized over the 5 years. This one is true. Let's see the other one also. At first, you like the indebted company should recognize equity balance. That's perfectly incorrect. So the logical choice is only C. Other choices, some of them were partially correct, but not the fully correct. So out of these four, the more logical and the correct answer is C. Which statement is correct? Parent company owns 35% of kid company, which it gives significant influence. Significant influence. Can I say associate? Normally, when parent is having the holding in another company between 20 to 50%, normally we say that other company is an associate for you. But we know that it's not the only holding which decides the company is your associate or not. When we say associate, then you will be having a significant influence. Significant influence can be identified very easily if you are having a directorship chair. For example, if you have got one directorship chair, so that directorship chair shows your significant influence. Another example could be, for example, you have got around 25% holding in that company, but whenever there are any technical issues, your team actually facilitates them. Assuming you are also helping them in their operating or investing activities, that also shows that you have a significant influence in that company. Okay, but here it is categorically written, so no issue at all. Parent company owns 35% of kid company, which gives it significant influence. During the current financial reporting period, parent company sold inventory to kid company. Now listen. When parent is selling goods to associate, so whatever is the unrealized profit, with that unrealized profit, obviously I'll debit that unrealized profit, retained earning will be debited. Now, since the stock will be with the associate, and actually we do not consolidate associate. What is the meaning of this thing? We do not consolidate associate. Actually, we do not merge associate books with parent books. Parent is the seller, associate is the buyer. So due to unrealized profit, you can say that associate stock, associate inventory is overstated, but we cannot reduce the inventory of associate. So that is why we will credit the investment in associate when parent is the seller. Parent company owns 35% kid company, which it gives its significant influence during the current financial reporting period. Parent company sold inventory to kid company for 8,000 and the margin is 30%. Margin is a percentage of revenue. At the year end, inventory remain unsold. Just a minute. 8,000. Profit margin is 35%. Parent's holding is 35%. Whenever there are transactions between parent and associate, you will have to use parent's holding, no matter whoever is the seller. 8,000 to 30% to 35. So logically unrealized profit is 840. Now logically unrealized profit, your retained earning will be debited by 840 and investment in associate will be credited. Let's see. Parent company has recognized a receivable balance 8,000 for this sale and kid company has recognized a corresponding payable. Now listen all carefully. Whenever there are receivable and payables between parent and associate, we never eliminate them. Why? Why we can't eliminate them? Because we are not as consolidating associate. So receivable and payables between parent and associate will not be cancelled out in group accounts because we do not consolidate associate. Yes, in case of subsidiary, we have to eliminate receivable and payable between parent and subsidiary. In fact, if there are payable and receivable between two subsidiaries of the same parent, so I have to eliminate that also in the group accounts. But parent and associate, no. Receivable and payable will not be eliminated. They will remain there. Only unrealized profit will be eliminated. Now let's see. Unrealized profit, the first thing is wrong. Actually, unrealized profit is 840. We have just calculated. Unrealized profit is 840 and receivable payable balances are cancelled. No, no. How can you do that? You cannot cancel receivable and payable between parent and associate. Again, third one is incorrect because of this. Unrealized profit is 840 and receivable and payable are not cancelled. The last one is true. Fit company owns 40% shareholding in Dot, 40, which gives significant influence. So Dot associate during the Fit company parent sold goods to Dot. At the year end, Dot still holds some of these goods. We know that unrealized profit is always in remaining stock. Again, the seller is parent. So obviously we'll eliminate the unrealized profit, and of course we will credit investment in associate because we are not holding the stock. Who's holding the stock? Associate. You cannot credit the inventory. Inventory, you can credit the inventory if associate becomes the seller and parent is the buyer. Here parent is the seller. So I cannot credit the inventory. Select the correct tokens to reflect the consolidated adjustment required in relation to unrealized profit in inventory. Okay. Of course, we have to credit investment in associate. Now let's see the debit. Share of profit of associate. No. Share of profit of associate means whatever my associate has earned, PAT, and multiply by parent's holding. Obviously, that will not be debited. So share of profit of associate makes no sense. Inventory does not make sense. Of course, cost of sales. Seller company, parent, cost of sales. So basically, parent company. When we are going to eliminate this intragroup transaction, so cost of sale of parent will be debited, investment in associate will be credited. Okay. Beware company has a year-end December X6. It entered into the following foreign currency transaction. Can I say IS 21 actually deals with foreign currency transactions? In the current year, transaction 1 on 25th October X6. Beware company bought inventory denominated in a foreign country. Beware company bought inventory denominated in a foreign currency. At the year end, inventory has been sold. However, the supplier has not been paid. Just a minute. Transaction 1. 25th October X6. First of all, by using spot rate, I will translate the foreign currency transaction amount by using spot rate. Spot rate is the exchange rate on the day of transaction. So on 25th October, whatever is the exchange rate, we will use that exchange rate to convert that foreign currency transaction to our functional currency. Your entry is going to be purchases. Your inventory will be debited. Logically, I will credit the trade payable. Now listen carefully. Let's say year end is December X6. Trade payable is your monetary item. This is your monetary liability. Now listen carefully. According to IAS 21, first, monetary items, either they are asset or liabilities, they are translated by using spot rate. Spot rate is the rate on transaction date. After that, retranslate on SOFP date by using closing rate. And whatever exchange gain or loss comes, that goes to statement of profit and loss. Repeat. Your monetary assets, your monetary liabilities, first we translate them on transaction date by using spot rate. Spot rate means exchange rate on transaction date. Second, if that monetary asset or liability is not settled before the year end, then on SOFP date, you have to retranslate by using closing exchange rate. Closing rate means exchange rate on SOFP date. And whatever exchange gain or loss comes, logically that gain or loss goes to P&L. I hope it is clear. That is transaction 1. Now let's see what transaction 2 says. Transaction 2. On 1st July X6, BBL company purchased equipment to be used in its operation paying in foreign currency. Now listen carefully. Equipment, when you are buying equipment, it's a non-monetary asset. Okay. The equipment is measured using a cost model and depreciate over a useful life 5 years. Now listen. Non-monetary assets. You will translate them by using a spot rate. Spot rate means exchange rate on transaction date. Non-monetary assets, they are translated by using spot rate. Spot rate is exchange rate on transaction date, number 1. Number 2, if you are keeping non-monetary assets at historical cost, then there will be no retranslation. Repeat. If I'm keeping non-monetary assets at cost model, then no retranslation. If we carry non-monetary assets at fair value, like in case of IAS 16, I'm following, let's say, revaluation model, then you will have to retranslate, and the retranslation will be made whenever fair value adjustment is carried out. We never say that if non-monetary assets are carried at fair value, then on each SOFP date you have to retranslate. No. According to IAS 21, non-monetary assets, they are carried at fair value. If they are carried at fair value, number 1. Number 2, you will retranslate them whenever there is a fair value adjustment. If you recall IAS 16, it is not necessary that always you will have to revalue at the end of the year. There are a number of questions where we do revalue them mid of the year, even a start of the year. So whenever there is going to be a fair value adjustment, then there will be retranslation. And plus one more thing. If I'm retranslating property, plant and equipment which is carried at revaluation model, so then exchange gain or loss, they will also be a part of that revaluation surplus and they will go to OCI. If I am assuming I've got investment property carried at fair value model, but investment property in a foreign country, okay? Obviously, I have bought the investment property in a foreign country. I have to convert that foreign currency to functional currency. I'm keeping that investment property at fair value. Then I have to retranslate the investment property whenever there's a fair value adjustment. Now exchange gain or loss will go to income statement. Why? Because under IAS 40 fair value changes, they go to P&L. So logically, exchange gain or loss will also go to P&L. Under IAS 16, revaluation goes to OCI. So the exchange gain or loss will also go to OCI. But in this question, non-monetary asset, obviously we have to translate on the day of transaction by using spot rate. Spot rate means exchange rate on transaction date, but no retranslation because of the cost model. No retranslation due to cost model on December X6. Now let's see the options. Trade payable is monetary. I don't know why they're saying asset. They should be saying liability. Monetary, yes, we agree with the monetary one. Okay, then what they're saying, no retranslation. Retranslate them, yes. Again, trade payable, you will have to retranslate. So trade payable, as far as you are saying monetary, I agree. Why you are saying asset, should have said liability. So trade payable, yes, it's a monetary item. You can say it's a monetary item, plus you have to retranslate on December X6. The equipment, yes, non-monetary asset. It's non-monetary. It's non-monetary assets. The equipment is non-monetary asset and not retranslated. So equipment, non-monetary asset, not retranslated. Okay. Which of the following option is correct in accordance with IS 21 foreign currency transaction? Again, IS 21. Freddie company purchased a building, paying for it in a foreign currency. The building was classified as an investment property, and Freddie company adopts IS 40 fair value model. Under fair value model, we know that fair value changes, they go to P&L. And under fair value model, if you are following IS 40 fair value model, then on each reporting date, you have to check what is the fair value of your investment property. Under revaluation model, it is not necessary to revalue the property every year, but whenever we are following the fair value model, then you have, at the end of each reporting date, you have to check what is the new fair value. For such properties, since the building was purchased, its fair value has increased and exchange gains has arisen. Great. The increase in the fair value exchange gains should go to P&L, perfectly all right. Because under IS 40 fair value changes, they go to P&L, so the exchange gain will also go to P&L. Then every option which says OCI is incorrect. Okay, let's see this one. Which of the following requirement reflects the correct accounting treatment for brand IS 38 intangible assets? Thirsty company manufactures Quench branded soft drinks. I like the names. Thirsty company manufactures Quench branded soft drinks. The brand was purchased from a competitor during the current year. Thirsty company management believes that Quench brand will contribute to the net cash flow to the entity indefinitely. Now stop. Logically, there are two types of intangible asset. One is internally generated. Second is purchase intangible asset. Over here, we are dealing with the purchase intangible asset. Number one. Number two. Question says it has indefinite life. When your intangible asset is having an indefinite life, so obviously we cannot amortize. Number one. Number two. Every year, irrespective of indicator of impairment loss, you have to perform impairment test. Let's see. What are the options? Amortize a brand over 10 years. Come on. Absolutely incorrect. There's no such thing, 10 years. When you are saying indefinite, then no amortization. Do not amortize a brand, but review the useful life when there is indicator to check. Indicator. Can I say either there's indicator or no, you will have to go for impairment. They're saying impairment only if indicators. Amortize a brand over 10 years, again, incorrect. Do not amortize the brand, but review the useful life each period. Check if there is evidence it has changed. Test for impairment annually whenever indicator exists. Obviously, annually, as well as if there are indicators before the year end, then do that also. So basically, you have to there's no need of amortization, and annually you have to perform impairment test. So the correct option is the last one. Okay, let's see. In accordance with IAS 33 EPS, the basic EPS in X7 presented as comparative in X8 financial statement instance. Basically, whenever in the current year there's a bonus issue or right issue or even both, then we have to restate the previous year EPS. So they are just asking you to calculate restated basic EPS. The following information to profit company in December X8: equity shares X7 share capital, I'm ignoring 3 zeros, 50,000, X8 it is 2 lakh. Par value is $2. Actually, share capital divided by par value. It gives us issued shares. During X8, there was a bonus of equity shares. No other transaction were issued in X7 and 8. So things are very easy. In X8, there is only bonus issue. Okay, we know that either there's a bonus issue or right issue or even both. You have to restate the previous year EPS. So restating the previous year EPS is very simple. How? In case of bonus issue, we simply make one assumption that company has issued the bonus at the start of the accounting period. So just do one thing. Take the profit 95,000. Share capital is 2 lakh divided by 2. It gives us 100,000. Logically, within this 100,000, we do have the shares of 25,000 shares. You can say they're coming from X7 because 50 divided by 2 will give you 25. In X8, company has actually issued 75,000 bonus. But in case of bonus issue, we assume that you have issued at the start of the accounting period. Let's say you have issued at the start of even X1. So just do one thing. Take the previous year profit, take all the number of shares because it's very simple. You will get $0.95. This is your restated EPS, but answer is in cents. So I'll multiply this with 100. So basically restated basic EPS of 2000 X7. This is what examiner is asking. So restated basic EPS is 95 cents. Okay. Now let's try this. Just read it once, student, a scenario. Then we are trying this. Let's see what question says. Just a minute. According to relevant IFRS accounting standards, how will the legal cost relating to the purchase of property 1 and its subsequent roof repair cost to be recognized? Legal costs. Okay, let's see. And property 1. Property 1 cost is 9 lakh. Was used by Osborne as a head office. Legal costs relating to the purchase. Can I say legal costs relating to the purchase will be capitalized? Yes or no, students, you can reply. When we are buying a property. So thank you for the confirmation. When we are buying a property, so obviously legal costs will be capitalized. There's no doubt about it. During the course of the year, December X7, Osborne Company had to repair part of the roof at a cost So simply expense out. Property 1, legal costs relating to the purchase capitalized and repair of head roof. Just expense out. Let's see what they're saying. The legal cost should be included as a part of initial measurement of the building, and the roof repair cost should be recognized. That's perfectly all right. The legal cost should be included as part of the initial measurement of the building, and roof repair cost should be recognized as an expense. Now let's read other options. The legal cost should be included as a part of the initial measurement of the building, and roof repair cost should be added to the note. Legal costs and roof repair should both be no. Leave it. What is the total amount that should be recognized in the statement of profit or loss in the year ended December X7 in relation to property 2? Read again, please. What is the total amount that should be recognized in the statement of profit and loss in the year ended December X7 in relation to property 2? Property 2. Osborne Company purchased 2 properties on 1st July X7. They bought 2 properties on 1st July X7. Property 2, cost is 300,000, was immediately rented to a corporate tenant 1,000 per month. Stop. 1st July X7 till December X7, rental income is 6,000. Of course, when I'm using investment property as rental, I've given that property on rent, so that's IS 40. Now I have to see either the property is on fair value model or cost model. Logically, investment properties should be at fair value model. On 1st December X8, Osborne leave that. Come here. The fair value of the building was as follows. Okay. Date December property 2. December X2, the fair value is 320. Let's see. Osborne Company measures investment property using what? Fair value model. Now listen. Under fair value model, investment property, no depreciation. Okay. 1st July X7, you bought the investment property for 3 lakh. December, the fair value has become 3 lakh 20. There's a rise in the fair value by 20,000 that goes to income statement plus the rental income of 6. So total income which you have generated in 2000 this till December X7 is 26,000. I hope it is clear. Under IS 40, investment property fair value model, no depreciation, number 1. Second, changes in the fair value, they go to P&L. Rental income, of course, goes to P&L. Okay, students, the last option. Now what? According to relevant IFRS accounting standards, what are the accounting steps that should be taken to correctly recognize the account conversion property 2 into sale office on 1st September X8? Actually, when you're converting property 2 to sale office, so actually you are coming from IS 40 to IS 16. You are coming from IS 40 to IS 16. Of course, when I'm coming from IS 40 to IS 16, first I have to see what is the updated fair value of my property. Let's see what options they are giving us. On 1st September X8, Osborne Company converted this property into a sale office on its own use. Fine. 1st September X8, the fair value is 337. So first of all, from actually 320, you have to bring your property to 337. Measure the property at its fair value. This is your step number one. After that, there will be reclassification. Once you have increased your investment property from 320 to 337, then you have to make the double entry property plant and equipment debit, investment property credit. Transfer the property between non-current assets. Now classification will change. Simply property plant and equipment will be debited and investment property will be credited, and then on useful life we will depreciate the property. First, fair value, which is 337. Then from 40 we'll go to 16. Property plant and equipment debit, simply I 16 property plant and equipment debit, investment property credit, and then we will depreciate. Okay. Which statement best describes the accounting treatment that should be applied to the decrease in the fair value of property 1 in the year ended December X8? Now, please, wait, let's see. Property 1 cost is 9 lakh and was used by Osborne as a head office. Legal costs relating to the purchase were 30,000. During the course of the year ended December X7, Osborne Company had to repair, we know that this. What are their policy? Osborne Company measures owner-occupied property using revaluation model and depreciated over 20 years. Okay, this some property 1. Can I say first they have revalued the property? Yes or no? They are following the revaluation model. Am I right? Property 1, you can see that they are depreciating over 20 years. First, there is a revaluation, and then we can see there's an impairment loss. Now, listen, after revaluation, when there is an impairment loss, so first, when I'm going to recognize the impairment loss, what do you have to do? First of all, we have to eliminate the revaluation surplus. If your impairment loss is over and above, then the revaluation surplus, then that goes to P&L. The decrease is always recognized in P&L. Can I say incorrect? Actually, according to IAS 36, when we are recognizing the impairment loss in XYZ property, plant, and equipment, first you need to check, is there any revaluation surplus in the carrying amount of that property, plant, and equipment? If yes, first you have to eliminate the revaluation surplus. Second, if your loss is over and above the revaluation, then only that over and above the revaluation goes to P&L. The decrease is always recognized in OCI and ROE. The decrease is recognized in other comprehensive income to the extent that a revaluation surplus exists for property 1 and thereafter. The decrease is recognized in P&L to the extent any previous increase for the fair value. So simply IAS 36, when I'm recognizing the impairment loss, you need to first check if there is any revaluation surplus. First, eliminate that revaluation surplus. Then, any loss which is over and above that revaluation surplus, that actually goes to P&L. Okay, which of the following properties which are also held by Osborne Company should not be recognized as an investment property? Should not be recognized. Red House, which is an apartment block occupied by Osborne Company employees, all of whom pay market rent. This is IAS 16. Because this building, this apartment is not available to everyone. They're just available to your own employees. Logically, you're using this property as an owner occupied property. Blue Tower, which Offspring company rents from an unrelated party, that is IS 40. Green Place, which is a land held for undetermined future use. It is written in IS 40 investment property that if you have a piece of land and you are undecided how to use, so simply IS 40 will apply. It's very simple, it's very common. You have a piece of land you don't know how to use, so automatically you are using it for capital appreciation. IS 40. Black Center, which is a shopping center led to retailers. If you're giving on rent, so Option only provides maintenance security. That's something else you have provided to the retailers. Again, IS 40. They're asking us which of the following properties which are also held by Osman should not be recognized. So the first one. First one. They're saying Option company provides maintenance and security services to tenant. Actually, the services of maintenance security, they are not, I would say, significant ancillary services. If you were providing significant ancillary services, then instead of IS 40, I would have used IS 16. Example, like hotel properties. In hotel properties, yes, we do generate rental income, but we provide significant ancillary services. Just imagine a hotel, there will be a proper counter for the reception. When you will take your luggage over there, someone will come, will help you, each and everything. So obviously hotel properties, they're not just giving room on rent, they are providing you the significant ancillary services. That is why on hotel properties I'm going to apply 16, even though we are getting rental income from there. In the last part, providing maintenance and security services, they are not significant ancillary services. So only the first one is not your investment property. Rest of three, they are your investment properties. Okay. In accordance with IFRS 3 business combination, the consideration transfer to acquire 85% equity shares in Dimley company in dollars. In accordance with IFRS 3 business combination, consideration transfer to acquire. So how much parent has given, we need to calculate that consideration. Brightly acquired 85% of Dimley company's 250,000 shares on 1st January X7 for 1.45 million cash payable immediately. So you have paid cash immediately 145. Okay. And share for share exchange in which one Britley company share was exchanged for every two acquired in Dimley company. So we need to know parent company's fair value. The market price of Britley company shares was 15. Simply market value of shares issued by parent. Subsidiaries having total number of shares 250,000. We have acquired 85% holding and parent has issued one share against two. And the current share price of the parent at acquisition is 15. Let's use a calculator. 250,000 2.85 divided by 2 into 15. So I am getting students 1593750. Let's see, is there anything? And Dimley company share was 8. Britley has elected to, there's something else. So let's see the consideration. Students, I'm getting 30,43750. Okay. In accordance with IFRS 3 business combination, what is the fair value of identifiable assets acquired and liabilities assumed on acquisition of Dimley? Fair value of asset acquired and liabilities assumed. Okay. We acquired this company on 1st January X7. The following information relates to Dimley company's January X7. Retain earning on 1st January X7. We know that retained earning is equal to net, basically equity side is equal to the net assets. Retained earning 1.2 million share capital. The carrying amount of all of the recognized asset and liabilities of Dimley were considered to be equal to their fair value at the date, with the exception of land whose fair value was 200,000 greater than the carrying amount. So can I say fair value adjustment? Land is 200,000. In its separate financial statement, Dimle Company had not recognized the provision for present obligation 140 that had only 30% likelihood of being settled. It's okay. You did not recognize in your individual books. It was your, you can say, contingent liability. But when we are acquiring your business, if we know the fair value of that provision, then we will recognize that as a liability. This had a fair value 90,000. So this is fair value adjustment. But this time we will treat this as a liability in group accounts. And due to this liability, net asset will reduce. And there is no other thing. So simply, let's use the calculator. Oh no. 650 plus 110. 200,000 minus 90. Students, I'm getting 1960000. Okay, let's go ahead. What is the carrying amount of non-controlling interest in Dimle Company reported in group statement of financial position December X7? Of course, we do not have that much information, so we can directly calculate NCI. First, let's check how they are measuring the NCI, either full goodwill or partial. The market price of Britley Company share on 1st January X7 was 15. Dimle Company share was 8. Normally, we'll read it nicely, don't worry at all. Normally, whenever subsidy share price is given normally, then they keep NCI at fair value. Means I'm talking about full goodwill method. Britley Company has elected to measure non-controlling interest in Dimle Company at fair value. So things have become easy now. Fair value of NCI at acquisition. Fair value of NCI at acquisition. 85% holding is with the parent, so 15% holding is with NCI at acquisition. Share price of subsidiary was 8, 2,50,000. Students, I'm having 300,000. Now, simply we have to see add share in post reserves. Add share in post reserves. Of course, in a long question, so we do the proper calculation. We calculate net asset at acquisition, at reporting date, difference post acquisition. But here we are doing it directly. Let's see what subsidiary has done in the post acquisition. In the year ended December X7, Dimle Company made a profit 75,000 and reported other comprehensive incomes 54. So I have to give 15% share of this 75 and 15% share of this 54 to NCI. So simply profit in the post acquisition is 75. OCI. So 75,000, it is 75 if I'm not wrong. Yes, 75 and 54. 11250. 11250 plus 8100. 3 lakh plus 11250 plus 8100. Student, 3 lakh 19,390. 3 lakh 19,350. The last option. There's one more option which is not given. So properly, it was not, I would say, downloaded. There's one option of NCI also. So match the token below to the choose that correctly reflects the consolidated adjustment required when preparing the consolidated statement of financial position 31st December X8 in respect of the sale made between Grimley Company and Britley Company. There's one option of NCA also. Now let's come here. Britley Company also holds 75% equity shares in Grimley, another subsidiary. During their ended December exit, Grimley Company subsidiary sold goods to Britley for 120, charging a markup. Now listen. In case of markup, if you recall, cost plus profit is equal to selling price. The cost is 100%. Markup, how much they are giving us? 20%. It means selling price is 120%. I hope it is clear. The selling price is 120%. Okay. And unrealized profit is always in the remaining stock. Am I right? A quarter of these goods were still held by Britley at the reporting date. First of all, your unrealized profit is 1,20,000. 20 upon 120. Then 1 upon 4. Because unrealized, unsold goods are only a quarter. And unrealized profit is always in the remaining stock. So let me use the calculator. 1,20,000, 20 upon 120, then divided by 4, it is 5,000. Now listen. Parents holding is 75%. NCI holding is 25. This is another subsidiary, okay? Grimley. In this question, there are two subsidiaries. In the second subsidiary, parent holding is 75%. NCI holding is obviously 25. Debit and credit. Parents retained earning, parent share with this 75% of this. 3750. NCI will be debited by 1250. Inventory will be credited by 5,000. Why we applied 75 and 25? Because seller is the subsidiary. If parent was the seller, then entire 5,000 retained earning would have been debited, and obviously credit inventory will remain same. Either it is seller, parent, or subsidiary. But when subsidiary is the seller, then you have to apply the percentage of parent and NCI on this unrealized profit. Now come to the option. Logically relating to the inventory. So inventory basically is 5,000. NCI is 1250. So there wasn't any option of retained earning. So when you will go to the proper ACCA CB platform, so you will see the proper question. So basically, right option is there is no debit credit. We have to just match. Inventory matches with 5,000. NCI actually matches with 1250. Other 6,000, 1,500, no adjustment at all. Okay. Which one of the following statement relating to the subsequent measurement of goodwill in Dimley Company does not correctly reflect the requirement of IFRS accounting standards? Which one of the following statements relating to the subsequent measurement of goodwill in Dimley Company does not correctly reflect the requirement of IFRS accounting standards? Let's see. The non-controlling interest is allocated a proportion of impairment loss in Dimley's company's goodwill. Yes. Why? It's a full goodwill method. That's why. It was mentioned in the question that, and we are keeping NC at fair value. So this one is true. So what we need to find out, subsequent measurement of goodwill in Dimley company does not correctly reflect. So you have to find out incorrect answer. This one is correct. The goodwill arising on the acquisition of Dimley is not amortized. That is also true. It's only goodwill. We only go for impairment. It's no amortization. The goodwill in Dimley must be tested for impairment annually. True. After impairment, the goodwill in Dimley company is measured in consolidated statement of financial position at its initial measurement less the group share of the impairment loss. That is incorrect. False. Why? Can I say, in case of full goodwill method, so whatever is the amount of the goodwill minus the entire impairment loss, you will not deduct the only impairment loss of parent. Only impairment loss of parent is deducted when it is a partial goodwill. When you keep the NCI at proportionate of net asset. Proportionate of net asset means partial goodwill. In case of partial goodwill, yes, we only deduct from the goodwill the share of group impairment loss. But in case of full goodwill, which is this question, from the goodwill, initial goodwill, you will deduct the entire impairment loss. So last one is incorrect. Okay, student, just read the scenario. Dorothy company, so apologies if the pronunciation is not correct. Not seen this name before. Dorothy company is a car dealership. Okay, we can say D company is a car dealership, provides maintenance services. The following information is relevant to the year ended 31st July X8. Agreement with the Lucy company. Should have said Lucky company. D company is an agreement with another car dealership, Lucy company. Lucy company keeps some of D company's cars in its showroom. If Lucy company sells one of D company's cars, D company pays it a commission. However, if D company finds a suitable buyer for car provided to Lucy company, it can immediately request the return of that car from Lucy. So basically, sort of, if you recall inventory consignment scenario, actually in that inventory consignment scenario, what happens? You are the basically owner of that inventory. It is kept somewhere else. Whenever that inventory will be sold, then you will be recognizing the revenue, not before that. According to IFRS 5, so consignment inventory case is this. According to IFRS 15, revenue from contracts with customer, which two of the following statements are true regarding the agreement between D company and Lucy company? D company should recognize revenue in respect of all of the cars. No, 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 no. Can I say false? How can you recognize if it was so easy then what to say? D company should recognize revenue from cars delivered to Lucy when Lucy has sold car to an external party. True. Lucy controls the cars located in its showroom. False. How can you? Actually, cars are under the control of D company. Whenever they want, they can ask you, give their cars back to them. Cars are located in Lucy's showroom are inventory to D company. Yes. D company should recognize revenue in relation to the proportion of the cars when they are delivered to Lucy. The proportion should be based on the expected number of cars. False. So logically B and C. Okay. According to IFRS 15, revenue from contracts with customer, which of the following statement is correct in relation to the sale of electric car? Electric cars, nowadays everyone is selling electric cars. Look, we have in our question as well, but I'm really surprised why so far we have not seen any question on IFRS 18. I was expecting at least few multiple choice questions should have been on IFRS 18. Okay, sale of electric car. D company sold an electric car to a customer on 1st May X8. The contract states that customer must pay D company $28,000 in 2 years' time. Appropriate discount rate is 8%. Students, 2 years' time. First of all, we have to calculate the present value. 28,000. You are not getting 28,000 today. We'll be getting this 28,000 after 2 years. 24,005. Okay. Now, year end is 31st July. Logically, the double entry of 24,005 is debtors debited by 24,005, sale will be credited by 24,005. Then due to unwinding of discount, your debtors will increase. Simply debtors debit and your interest income will be, finance income will be credited. So how many months? We are selling it on 1st May, June, July, 3 months. So 3 months, 24005 into 8%. Logically, the finance income is 480. So your total debtors value will be 24005 plus 480. Students, I'm getting 24,000. So basically, during 2008, you can say that your debtors are debited by 24,485. Revenue was credited by 24,005, and your finance income is credited by 480. Logically, you can say that your P&L, entire P&L during 2008 due to this electric sale is credited by 24,485. Now let's see the options. D company should recognize an interest expense. Why interest? We are selling electric cars. D company should recognize income. Wow, that makes sense. Let's see other option. D company should not recognize any revenue. Why? Actually, under IFRS 15, the moment I have delivered the electric car, I have fulfilled the promise. Once I have fulfilled the promise, so I have to recognize the revenue and the receivable also. D company should recognize a receivable. Why 28,000? I'm not getting the amount just after 2 days, 3 days. I'm getting this amount after 2 years. Obviously, here the financing component is significant. When financing component is significant, I have to go for the discounting. Simply when you are getting the amount after 1 year, you should be discounting the amount. So logical option is option B. Okay, let's see. What revenue should D company recognize in respect of the sale of car and maintenance services in the year 31st July X8? What revenue should D company recognize in respect of the sale of car? Sale of car, sale of car. D company entered into an agreement with another customer on 1st April X8 to provide a new car 28,800 and one maintenance service free of charge. One maintenance service free of charge. Similar maintenance services are provided by several D companies' competitors. The service will be performed when the car has driven 20,000 kilometers. By 31st July X8, the customer has driven only 8,000 kilometers. Ordinarily, the maintenance service is 3,200. Now listen. You have sold a car. Try to understand. You have sold a car 28,800 and you have given free service. Free maintenance service. Standalone maintenance service price is maintenance service cost is 3,200. Logically, we are not charging anything against this maintenance service. You can say we are selling them at discount. Okay. Now, as soon as I'm going to deliver the car, so the revenue relating to the car I'll recognize immediately, but revenue relating to the maintenance I cannot recognize immediately because I will provide the maintenance once that car has been driven for 20,000 kilometers. Right now, it has been driven only how many kilometers? 8,000. So it means I have not provided any, by 31st March X8, I have not provided any maintenance services. Now, what to do? The total value of these two products are 28,800 plus 3,200, 32,000. Okay. The transaction price in the question is only 28,800. So logically, I have two performance obligation. One is to deliver car. Second is to provide maintenance services. And both the promises, both the performance obligations are distinguished. Both are different from each other. Now, transaction price is 28,800 and I have to fulfill two performance obligation. Both are distinct performance obligation. So according to IFRS 15, we have to allocate this transaction price according to the stand-alone prices of performance obligation. So look at this, 28,800. Total price of delivering the car and providing maintenance services 32,000. Now, how much we will allocate to the car delivery? Let's see. 28,800. We are just allocating the transaction price on individual standalone selling prices of the performance obligation. So 28,800. Students, the revenue relating to the car is 25,920. And the revenue which relates to the revenue actually which relates to the maintenance services 2,880, but we cannot recognize it at all. Even though the car has been driven for 8,000 kilometers, still I cannot recognize any revenue relating to the maintenance services. Why? Because we have not provided that performance obligation. Maintenance services we will only provide when the car has been driven for 20,000 kilometers. So only the revenue relating to the car is 25,090. What revenue should de-recognize in respect of the sale of the car? So sale of the car is 25,920 and maintenance service is 0. I hope it is clear. There is no revenue relating to the maintenance services, but yes, we will recognize the revenue relating to delivery of the car. In relation to the fleet maintenance contract, select the correct answer to indicate what balance the company should recognize in its statement of financial position, July X8. So we don't have options, but let's read the question. Fleet maintenance contract. On July X8, the company won a lucrative 1,20,000 contract to provide maintenance services for a fleet cars owned by a corporate customer. Started immediately. The contract lasts for 2 years. Customer paid 50% of the transaction price when the contract began. Will pay the balance at the end of the contract. In a bidding of the contract, company incurred 18,000. That's something else. Read the question again. In relation to the fleet maintenance contract, select the correct answer to indicate what balance the company should recognize in its statement of financial position. If I just give you the idea. Cash or bank, we are getting 50%. July X8, I'm just telling, of course, you will be debiting cash on 1st July, but what will be on 31st July, I'll tell you. So we have to, the time period maintenance service contract is for 2 years. From 1st July till 31st July, 1 month has been passed. Now this is different, okay? It is not like that you have to drive the car for XYZ kilometers, then we'll provide the maintenance services. This is something else. It's a very different. Maintenance services for a fleet cars owned by a corporate customers started immediately. So I'll be providing them services over 24 months. So simply, how much we have actually received in advance? We have received 60. Total price is 120. I have provided services only for 1 month. So 120 divided by 24. I've got 5,000. So basically revenue is 5, and still you have a contract liability. Again, we do not have any options over here. If you go to the ACCA platform, you will get the options. According to me, this should be the one. Let's see what else. Okay. In relation to the cost to win fleet maintenance contract, what expense should D company recognize in P&L in the year ended 31st July X8? In relation to the cost to win fleet maintenance contract, what expense should D company recognize in the P&L? Let's see. Basically, if you have incurred any cost in order to get this fleet maintenance contract, first I will capitalize that cost. Then, of course, with the passage of time, over the period of time when I'll be recognizing a revenue, then I will have to expense out. Let's see. In a bidding of the contract, the company incurred 18,000 in costs that would not have arisen otherwise. It has also spent 9,600 worth of management time on a bid. Basically, 9,600 actually is not the incremental cost which relates to, I would say, this contract. This is simply you are apportioning the cost of your management. They are your permanent employees, obviously. So 9,600 is not the cost relating to this contract. Only 18,000 actually relates to the contract. First, you will capitalize 18,000. Then, with the passage of time, as we will be recognizing the revenue, then you will slowly and gradually expense out this 18,000. So far, we have recognized revenue 5,000 out of 1,20,000. 18,000 multiplied by 5,000 divided by 120. I'm getting 750. This 750 will be expense out, plus this 9,600 you cannot capitalize. It has to be expense out. So total expense out is 10,350. Let's see the option. In relation to the cost to win the fleet maintenance, what expense should D company recognize in the P&L? It has to be 10,350. So students, that is all about section A and B pre-scene mock FR. Coming inshallah Tuesday, we will be having a class for section C. Plus, we will be discussing, other than section C, number of other questions as well. And again, it will be an open class for everyone. Whoever wants to come and join the class, more than welcome. Plus, our enrolled students, if you have, again, the offer is there. If you have any query in the Kaplan kit, I would say BPB kit, even on a study hub, you can always ask the question in your relevant WhatsApp groups. So hope to see you all and others in the next class. So thank you very much that you people have taken out time for today's class. Thank you.